Warren Buffett's ability to determine which stocks to invest in has long been appreciated by investors. Buffett, who has been praised for constantly sticking to value investing ideas, has a net worth of over $124 billion as of 2022. He has resisted the urge to invest in the next big thing, and he has also utilized his enormous wealth for good by donating to organizations. With his extraordinary ability to identify long-term lucrative investments, most investors understandably want to know how exactly what Buffett looks for in a stock. Number 1. Choosing stocks using value investing. Understanding how Warren Buffett chooses winning stocks begins with an examination of the investment strategy of the company with which he is most closely connected, Berkshire Hathaway. When it comes to acquiring shares, Berkshire has a long-held and public strategy. The company's earnings should be steady. It should have a decent return on equity, ROE. It should be managed well, and it should be reasonably priced. Buffett is a follower of Benjamin Graham's value investing school. Value investing considers a stock's inherent value rather than technical indications such as moving averages, volume, or momentum. Understanding a company's financials, particularly formal records such as earnings and income statements, is necessary for determining intrinsic value. There are several noteworthy aspects of Buffett's value investing method. Buffett employs 4 critical elements to analyze the attractiveness of a potential investment to inform his selections. How has the business fared? Those that have provided a positive and acceptable return on equity for a long period of time are more desirable than companies that have only had a brief period of solid returns. The more years of good ROE there are, the better. An investor should examine at least 5 to 10 years of a company's ROE in order to effectively measure past performance. When examining a company's historical return on equity, it's also important to compare it to the ROE of the company's top competitors in the same industry. Number 2. How much debt does the business have? A high debt-to-equity ratio should raise an eyebrow because more of a company's earnings will go toward debt payment, especially if growth is only coming from taking on more debt. Buffett, on the other hand, prefers earnings growth to originate from shareholders' equity, SE. A corporation that has positive shareholders' equity generates enough cash flow to satisfy its liabilities and does not rely on the debt to stay afloat. Low debt and sustainable shareholder ownership, according to Buffett, are 2 critical components for successful stock selecting. Number 3. How do profit margins work? Buffett seeks companies with a high profit margin, especially if the profit margin is increasing. He evaluates the profit margin over multiple years, like he does with ROE, to discount short-term changes. To keep on Buffett's radar, a company's management should be capable of increasing profit margins year after year, indicating that management is also capable of controlling operating costs. Number 4. How distinctive are the company's products? Companies that generate products that can be easily replaceable, according to Buffett, are riskier than companies that give more unique offers. For example, an oil company product, oil, is not particularly distinctive because customers may obtain oil from any number of other competitors. However, if the corporation has access to a higher quality oil that can be easily refined, that could be a worthwhile investment. In this situation, the company's preferred grade of oil may provide a competitive edge, allowing it to make profits through increased sales and margins. Number 5. What is the current share price discount? This is the crux of value investing, identifying companies with strong fundamentals but trading at a discount to their true value. The greater the discount, the more room for profit. The goal of value investors, such as Buffett, is to find firms that are undervalued in relation to their true value. When a company's current market value is less than its inherent value, a buying opportunity exists. While there is no specific formula for calculating intrinsic value, investors will use a range of elements to determine intrinsic value, such as corporate governance and future profit potential. And now, Warren Buffett's investment strategy. Value investing is Warren Buffett's investing strategy. Value investing entails buying stocks whose share price is less than their intrinsic or book value. This indicates that the stock is now undervalued in the market and it will rise in the future. What are Warren Buffett's investing fundamentals? Warren Buffett believes in many investing ideas, but one of the most important is investing in yourself. He has emphasized that becoming educated and wiser can help you become a better investor. He also believes that investing in oneself entails excellent financial behaviors such as not overspending, avoiding credit card debt, saving, and reinvesting gains. What businesses does Warren Buffett own? Buffett's main assets through his company Berkshire Hathaway are Apple, American Express, Bank of America, and Coca-Cola. And now, the bottom line. Buffett is regarded as a buy and hold investor in addition to his value-oriented technique. He is not concerned in selling shares in the near term to generate capital gains. Rather, he selects stocks that he believes have high long-term growth prospects. This causes him to shift his attention away from what others are doing. Instead, he considers whether a company is in a strong position to make money in the future and whether its stock is reasonably valued.